What is going on, everybody? Welcome to Market Talks here on Cointelegraph. I am your host for today. My name's TA Tim. I'm from the Crypto Jeb team, and I'm so excited to bring you guys this episode where each and every single week we bring you all of the best information you need from some of the industry leaders and greatest influencers out there. And I'm so honored today to be joined by Nicholas Merten, and he is just absolutely phenomenal. Nicholas is the founder of Datadash. Some of you guys know him by that name. He's one of the largest cryptocurrency YouTube channels with over 500,000 subscribers. He's been an international speaker, thought leader, and crypto analyst in the space over 10 years with experience in traditional markets to understand the potential of cryptocurrencies. But let's roll a video with a little bit more information about him. Boom. The last thing that none of that said was he's also a fellow Virginian. So those of you who don't know, I came from Virginia, but Nicholas, you're also from Virginia, I understand.
That's correct. Yep. Yeah. So
where are you?
Born and raised in Virginia.
Yeah. Where are you located right now?
So I'm in Europe at the moment. I traveled. I basically made the trip over in about 2020. Started looking around and stuff, a couple of different cities, and finally made the move in 2021 at one of the most unlikely times, and absolutely been loving it. But I also love getting back to the States as well.
Man, that's all cool. We got to talk a little bit before the show. I'd love to go out there and see all of Europe and definitely go out and see what you guys are doing. But, I want to go ahead and jump right in because we could probably do a show for like 3 or 4 hours talking about the crypto space, but we got to keep this to like 40 minutes. So let's dive deep in here. I want to start off. Let's just go right on in with Bitcoin. I want to hear what your overall thoughts about the market are right now. Let's start. We'll talk probably a little bit more later on the show, but do you think the bottom is in, or do you think that we maybe have another bottom to go here in the next little bit?
Yeah, I mean, my thoughts for Bitcoin right now is that in the near term, for the coming weeks, we've got more upside to come. I think that we are going to get up to one of those big target ranges. Likely, there's a chance that we could hit 30K. I do believe, though, that we are going through a typical bear market relief rally that's going to ascend for the coming weeks, and then we are going to probably come back down to that bottom range and get a double bottom in the market. We've seen this in the past many times from the previous bear market. After the rally all the way to 14K, we came all the way back down to $39,000, just a couple $100 spread from the previous lows. And from the previous bear market before that, we also saw a similar pattern where we had nearly a year's long sideways consolidation and a revisit flush back down to the lows. And I think that is more likely now than ever that we're going to be getting that, as well as a pretty exacerbated relief rally due to the fact that this market is driven by credit and leverage. So I guess if you want, I can dive into the charts and we can kind of kick off that conversation as well.
Yeah, let's go ahead and get that chart up because that's the question on everybody's brain is this rally we're going through right now, did the bottom come in and are we rallying back up to all-time highs, or is this just a relief rally? And I'd love to see your charts and see what you're seeing on them.
Absolutely, man. Yeah. So to kick things off here, I want to go ahead and try to talk about really what's happened over the past month. Before this breakout we saw back here from around 20,000 to 23K. So the important thing to understand about markets is there's a couple different ways you can trade crypto or practically any asset class. Most people generally trade spot. They're just buying Bitcoin or selling Bitcoin or trading their favorite altcoin in and out of the market. And considering that, we also need to consider that there is a market known as derivatives. Derivatives play a major role. They drive a lot of the volume and liquidity and value traded within this market on an active basis. Now, during the past month, we've been going through a consolidation channel here. Price has been going sideways for over a month here up until mid-July here, where we finally got to pop out a major deviation off of the trend here. Whereas the past few previous times, we deviated maybe slightly in and out of the channel, each time going back down and testing the bottom part of the top part of the range. Now, during this period of time, a lot of people were placing some pretty big bets. They were pretty volatile times. You had Celsius, Voyager, BlockFi, a whole range of companies really going through this major bankruptcy or restructuring period. A lot of people getting liquidated out of their positions, whether they wanted to sell or not, effectively being forced to sell and exacerbate the correction. And that's what led us down into this territory in the first place. And that's exactly also what happened as well back here in May of 2022. We basically had a month period of consolidation, and essentially price basically screamed on the spot market it wants lower. And now the sell-off would have come in, but it was more exacerbated here because of the liquidation, the margin calls and liquidations that came and followed. Now,
Yeah.
a lot of people think that that can only happen to the downside. It can happen to the upside as well. And just like how we can get exacerbated corrections due to this liquidation metric within the market, you can also have not only just longs getting liquidated, you can have shorts getting liquidated. Now, it is very probable that if we had a significant enough breakdown below this previous support range that we were consolidating on for a long period of time, price would have sold off down to 14, 15K. Probably very predictable, unless there was buyers who'd want to come into the market. Now that we've squeezed up here, we're going to talk a little bit later on about how there's not only a ton of dollar liquidity that probably wants to enter into the market at these discounts, providing a good buy opportunity, but even if not much buyers come in, if just enough come in to push up prices to 24, 25, 26K, it's not hard to think that we could come up to 30K because of the elements of a short squeeze, the complete counter opposite of what we saw back here throughout the month of June, as well as here in the month of May that led us into these consolidative zones.
Yeah, so even right there, I want to stay on your screen, and I want to talk about that because a lot of people are kind of almost acting like 30,000 is this myth, like that's that number right there. People are saying we're gonna go that high, but we're not actually going to do that. What are your thoughts? What would you say to someone who's kind of sitting here saying, I don't believe that Bitcoin can get back up to 30 right now. I think it's going to take a lot more time. What would you say to someone like that, and what is your reasoning on those charts to say that 30,000 is a lot more plausible than some give it credit for?
I will be self-critical, looking back over the past couple months. A lot of people, including myself, were thinking that, man, you'd be really hard pressed for Bitcoin to break that 30K support level back when we were up from 40 to kind of 35K. I thought that as we came down into that range and retested the May 2021 lows at around 30,000, that this was like, the temporary bottom. We've got move upwards. We're going to retest the highs. And a lot of people thought that level couldn't be broken. And if we look at the chart, I mean, we got a clear breakdown in this case. That level was completely, basically completely crashed through it. And the consolidative range came down here. We couldn't hold it. We didn't get buyer support coming in. And it was enough sell side pressure to put us into yet another domino effect of liquidations, of forced selling in the market. And I think it's the same kind of arrogance, to be honest. Maybe it's a bit of a harsh term, but it's that same kind of narrative of, please, it can't happen. The fundamentals won't allow it. The macro environment, right? Same kind of arguments that we would have said, but before, you got ETH, the merge, you have all these optimistic things that just couldn't let us come down below 30K. I think markets are completely irrational sometimes. That's the thing that people don't understand sometimes. And I've learned honestly the painful way through traditional markets and crypto is that markets can stay irrational longer than you think. And the crazy thing about it is that when we get up to this 30K range, and I just want to kind of map out what I think is going to happen here, just going off the chart. I think that we've still got the momentum potential to come up here to revisit this $30,000 range chart. And the first thing we're going to start to face resistance with and eventually start to face chop with is going to be these descending lines here. These are moving averages. They are the 200-day moving average and the 200-day exponential moving average, which of course moves a bit faster than the simple moving average. But these are going to start to come down here. And we're going to have to see whether or not price can turn up above them and make them support and actually justify a higher trend, or if they're going to get shot down. And I really think that we're going to set up to eventually break down here. Don't take my drawings as gospel, of course, but this is kind of just a framework in mind to kind of visualize it and eventually come back down into this consolidative range, probably at a higher low here. To see that we had this strength here in buyers coming in, this signals that for the past month, there were buyers coming at this range. This is an interesting price range for people to come in, and it's at a really solid discount. It would make sense that some buyers might come in here and want to formalize an official bottom and a start to the next rally sometime in 2023. But I think that this is a relief rally. It's not one that's just going to be a week long, but it will go into the later part of July and potentially early August into the summer.
I want to pause you there. My name is TA Tim. That's what I'm go by. So by the name, I love technical analysis. So I love hearing this. A lot of people will give feedback for technical analysts, though. They'll be like, all right, what are these lines? I know people say, we have to go to that line and touch it. Could you, for anyone who is kind of newer to technical analysis or not really sure about technical analysis, could you go into depth on the importance of those 200 daily lines, those moving averages? Because they are really important, but I don't think some people fully understand just how important they are.
That's a very good point, Tim. And look, like TA is a very subjective thing. I don't want to say that it's the ultimate indicator to rely on. There is no one single indicator that's absolutely going to tell you when to buy or sell. But the 200 moving average, especially on significant time ranges like the 4 hour time frame, the daily, the weekly, has incredibly significant value in financial markets because it is one of the longest standing utilized indicators in traditional markets. And of course, what I found when I came into crypto in 2017 is that, all the while over time, I think its effectiveness is not as valuable. Back in 2017, like core technical analysis patterns were what really mattered, but you had to zoom out. You really had to like look at the longer term timeframes. And if you look time and time again at the 200-week moving average, for example, and I could bring up the chart here. If we take a look at the longer term time frame, we can see that for Bitcoin, the longer term all time history, I'll go ahead and pull up here on the chart. If we get here to the weekly time frame, this is typically where we're going to get some type of accumulation or buying. When we come down to this range here, anytime we go below that 200 moving average, buyers usually find this to be capitulative entry territory. And no matter if it's an absolute bottom or not, we hung below this range here for quite some time. We weren't rolling back over, and buyers are pushing up price. They're signaling that, hey, this is a value range here. And if we look back at history, anytime we dip below here and we come up, we usually are going to come up at least to the 200-week EMA here if we're taking inspiration from 2018. Or if we go all the way back to the previous cycle here, right, we're at least going to push up above those moving averages and range sideways for a while. So yeah, I think that to that point, again, like I could go on a lecture for hours, but to the point you're talking about, Tim, it's a indicator that traditional financial investors utilize in traditional markets, even day traders utilize on shorter time frames to find entries and exits. So, and to find support and resistance, essentially.
Another question I have for you. So, in my TA, I think there's a couple different things we're looking at, but I want to ask for you, is there anything you think right now, is there a point that you're looking at that's separating us between right now, I believe we're sitting in the lower $23,000 levels and that $30,000 level? What are the price points you would advise anyone to look at to say, hey, make sure you understand what's happening around these price point levels because these could reject us and not allow us to get to 30,000?
Yeah, I think one of the greatest charts we could take a look at here is taking a look at the ETH to BTC ratio. So one of the things right now that I have to say, we had a target for Ethereum to come up to this upper green band here. This is the ETH to BTC ratio, so it's comparing Ethereum's performance against Bitcoin. And what we saw here was really fascinating. We saw kind of like a whipsaw move here where we broke below this ascending channel. This spooked a lot of people as it was happening over multiple trading days, and it just kept getting worse and worse. And when we had the the U.S. Bureau of Labor Statistics come out with the CPI numbers, and they were really bad in a lot of people's eyes. It was really only what about 10% of banks had estimated for really kind of the worst case scenario. Lo and behold, markets reacted really well to it and pushed us back into the channel. And we came, of course, this was essentially a deviation at this point. And the rule is that when you deviate from the channel or consolidation pattern, you're going to come up and revisit the highs. So when we saw that breakout higher, we called on the channel that we come up here. What was crazy and what I didn't even expect is that we completely went up here and deviated on the top part. And now it's a question of whether or not the ETH to BTC ratio can hold out on this 200-day or 200-day EMA, which I think it's going to consolidate against for the next couple of days, as well as this line of previous resistance to see if it can become new support. If we continue to like kind of chop in this range and build an ascending triangle, that's essentially going to set the stage here for sometime in late July, early August to just continue that trend where Ethereum is outpacing Bitcoin. And I think in dollar terms, all cryptos are going to continue to move higher here into the summer relief rally. Again, a lot of people think that it's overbought now. And I understand where people are coming from. It's made a major move here. But if there's enough liquidity in the market, if there's enough liquidations at those price levels up above this range, a lot of people loading in short, it's just going to add fuel to the fire. And that's just going to lead the rally to be even more exacerbated. But what do you think about it, Tim? Like, I'm curious what your thoughts are on this.
Yeah, no, I mean, so I would have thought, and I was actually, I talked about this on the show a little bit ago. When you go back and you look at the last couple of months, and when we're looking at the CPI numbers coming out, when we're looking at the FOMC reports, we've seen, there were different times where those numbers led to some rallies, and there was other times that it led to losses. And more recently, even the CPI numbers had some losses. So I was one of the ones when I saw that 9.1, I thought we were going to go down. But when I went back and looked at it, and I was really evaluating it, what people even need to understand about Bitcoin and commodities is it, of course, is going to respond in an opposite direction of the power of the dollar right now. That's just how Bitcoin is
Right.
working. So, in hindsight, the CPI, the numbers, they only had effect when it's so high that we think that the Fed is going to have to come out with just some outrageously aggressive numbers to raise the interest rate, which would bring power back to the dollar. And if the dollar gains power, so that one of the charts you would look at for that one would be the Dixie, the DXY. When it gains power, of course, Bitcoin and other commodities, because that's how Bitcoin is treated, is going to go down. When they're not going to raise interest rates very hawkishly, when they're going to be a little more dovish, it actually would bring power back to Bitcoin. And so I think that was the confusal. Is I think myself and others thought that when we saw that 9.1, we thought that the Fed was going to maybe be a little bit more hawkish. And we have to wait here a couple more days before we actually find out that number. But it's looking very much like they're just going to stay right at 75. Whereas in reality, when we're looking at these inflation numbers, most economists are saying we really probably should go to that 100 basis point, maybe even go 125. But it's looking like Powell is going to stay at 75, or at least that's what the futures predictions are saying at this time. So with that being said, those 9.1 numbers, that doesn't really mean anything. What really matters is, hey, are we pricing in what we think the Fed is going to do with the power of the US dollar? And then, of course, yesterday we had those numbers come out with the euro, and then we've also heard about the British pound. It looks like those interest rates are actually starting to climb, giving those currencies more power, which, of course, affects the Dixie, which, of course, for those of us who trade Bitcoin over the US dollar, it will affect us. So I think the rally, it was a surprise to me, but in hindsight, it's very easy to say, all right, let's go back and let's rewire our brain. Let's not focus on inflation. Let's focus on power of US dollar. And every time the power of the dollar goes up, the authority and the power of Bitcoin will decrease because they're very much inverse right now. Vice versa, of course, when the power of the dollar goes down, I think Bitcoin will climb. And that's what I think what we're going to see happen here if nothing changes is the power of the dollar is going to continue to decrease, and that'll cause Bitcoin to climb.
Yeah, exactly. To your point, Tim, there's a chart you just reminded me of. I just got it pulled up here. And this is something that people need to learn about the Federal Reserve that I think, again, people think they take the Fed at their word. And all the while, they have been very good about raising interest rates over the past couple of months. This is a chart. It's a little bit outdated now, but it showcases a similarity of the inflation wave we're going through starting from January 2020. With the implementation of a lot of the stimulus that's then started to really have inflationary pressure in 2021. And it's mapped back from the wave of 1972 into the 1980s. So each of these, I think we go from the 50 interval 100. This is months of time moving throughout here. And you can see that in the previous wave here, we got to very similar territory to what we've gotten to recently. We got those numbers, I think, at 9.1%, if I'm not mistaken. And back in the past, we went to around 10 to around 12%. And then after that, inflation cooled down here. We got all the way down to 5% year over year. And people thought this is where wages catch up. This is where the Federal Reserve can start to ease. And they started to ease because the Fed will always chase some temporary relief, essentially, to cool down the fear in equity markets and push asset prices up in order to hopefully stimulate the economy again and avoid a recession. But then, just like we saw here back in the late 70s, going into the 80s, we see it yet again start to spike back up and go all the way to 14.8%. And this is where the Fed had to pull what was known as the Paul Volcker rule, where it's like, we're going to lay down the law. We're going to jack up interest rates to astronomical levels. It's going to kill housing demand. It's going to slow the economy. It's going to stop credit creation. And then eventually, we know we're putting the economy into a recession. We've got to. And the Fed's kind of playing on a thin line, trying to hint towards that, but they don't say it outright. They need to put the economy in a recession. And once we get that, it's going to drag inflation down low enough where we can start to see asset prices go up. And I think, like right now, we can see here, if we take a look, this is the current federal funds rate at the moment. We're at 1.2 basis points. In this. Yeah, for sure. Absolutely. Yeah. Can you see that good? Or maybe I can zoom in a bit more. There we go. So this is the federal funds rate at the moment at 1.2. And the effective thing that I want to emphasize here is that, exactly as you mentioned, Tim, we've got the 75 basis point hike coming up here. That is where we're going. And I think the markets are seeing relief because the Fed is very stern. I mean, there was tons of hints after the CPI report where Fed officials kind of leaked unknowingly that, we're not doing 100 basis points. So if you add the 75 basis point hike, I think over the next two preceding FOMC meetings, we're going to add a 50 basis point and a 25 basis point. The Fed is going to start to cool down, and that they're going to basically take it to about 2.7 here roughly speaking, around this range, a little bit higher than where we were back in March 2019. The reason I think they're going to do that is exactly the points you talked about, Tim. You've got oil, which is cooling down. I think we're going to probably see, even again, if it's temporary, a breakdown below the 200-day, which has been generally acting as support for oil. I think natural gas will start to cool down a bit. And on top of that as well, this is the chart that is like the most damning of all. This is the 30-year fixed rate mortgage average in the United States. We've been 4 decades of, and basically a 4-decade long trend of declining mortgage rates. And it's not to say that long term this might not tick back up, but we need to understand how fast the Fed has been accelerating rates and how that affects essentially other rates in the market, like the rate to borrow capital in order to buy a home, which is a mortgage. And take a look at this acceleration here. In about 18 months, the cost to borrow money to buy a home has gone up effectively 108%. Right. In real terms, we've gone from around 2.6% to 5.5%. Wow. Like, to put this in perspective, I don't know the exact numbers. Like, if you wanted to buy like a certain property, whatever value, and that property required you had an income, like a dual income of like $200,000, you'd effectively need, I think, something along the lines of like an income of $300,000, like some huge astronomical increase in salaries, which just isn't going to happen for people. So less people are going to be taking mortgages. And this is how the Fed is trying to cool down demand, because there's such a supply shortage in the housing market and a lot of demand still to buy those homes.
You know, it's interesting. I feel like, Nick, in the last 3 minutes, you just opened up so many when I said we could talk for 3 hours, what you just talked about right there is why we could talk for 3 hours. But I'm going to try to pick at your little ones. First of all, you talk about the interest rates going up and oh my gosh, I know Kevin O'Leary, for example, who I think is coming on this show sometime soon. He's been on record as saying, here in the future, you're not going to own anything and you're going to love it. And I think specifically he's talking about housing. Like, it's going to get to a place where if you cannot put cash down and buy that house in cash, you're not going to buy a house. That's what we're seeing happen here in Florida, to where a lot of people are just coming from northern states and they're just buying every single house comes on the market with cash, because they realize if we can get this now, there's some scary things ahead, and people just will be in a spot where they cannot buy a house. They'll have to rent, and we can capitalize on that with the real estate market. And it's kind of scary. I don't know if Kevin was saying that in a good way or a bad way. What he was kind of playing on is, hey, it's going to be a place where you won't own anything, everybody else will own it, and you'll just rent it from them, but they're going to make it in a way that they're deceiving you into being happy about it. But I think what you're talking about right there, that's exactly what we're seeing play out with these interest rates. And here's what, taking that a little bit farther, I'm going to ask you to go back to the other point you were talking about, how you think potentially we'll see a 75 basis point hike here. The next time we get to see an interest rate hike is going to be actually in September. So they'll take August off. We'll still see CPI come out. We'll still see, is inflation actually curbing? Is it going up? But then we'll see another number in September and October. And I believe November's taken off, and then we see December again. I'll have to fact check that. But you're saying that you think 75 here in July, September maybe 50, and then October a 25 basis point. Is that correct?
Yeah, I think the Fed is basically under the assumption that, and basically the CPI is really being driven by one thing now, and that's commodity prices around energy, so oil and natural gas. I simply think that the Federal Reserve thinks it has it in the bag, as it typically does. It eases too soon, and as you mentioned, that's over the course of a couple months going into the fall that we're really going to start to see that, because I think essentially that the Fed They want to play tango. They always do this. They essentially try to just ease enough, but they understand that they need to tame inflation long term. The unfortunate thing is that instead of going hard and possibly even doing that 100 basis point hike, which honestly seems like very much like a Paul Volcker move, like consecutive 1% hikes in this case to essentially put the economy in a forced recession, that would probably be the right thing to do, the painfully right thing to do. But actually, I got here up on the chart exactly to your point earlier, Tim. I think this is the setup here. You've got other foreign central banks raising their interest rates, and you've got the United States starting to eventually cool down. And I'll point to this. Not only is this what I think generally is going to happen here, we're going to come back in this consolidated pattern for the dollar index, which means we've got about a 2% decline here in the dollar. A lot of people thinking this will be the top here. But again, I think eventually we're going to spike back up. I'll turn off my drawings here. I think what we've got here for the dollar is a revisit back up to a long-term line of resistance. We've written about this in our newsletter a lot, coming up to this range here over sometime in 2022, 2023, and that secondary wave of inflation where the dollar is gaining dominance against other currencies. But it takes time to play out. And I think a lot of people are going to look at this monthly candle here and go, oh my gosh, it's a clear top. Like it's an exhausted candle, has a very tall wick at the top, and they're going to think the dollar's in. But if we take a look at the 30-year yield here, this solidifies it even more. This is again, those moving averages, but this is on the monthly time frame. So we're talking about significant moving averages. And the 30-year yield is what you get. Yeah, it's what you get on a 30-year treasury note from the Fed. Excuse me, from the government, essentially. Now, when we take a look at this chart here, we got a clear rejection here in the short term. And what I think is going to happen here on like a pure TA perspective, but it also plays out with our assumption what the Fed's going to do, it's going to come down to this range here when the Fed is starting to lower tightening, where it will come back here to 2.5%. We're already seeing that start to play out here. The bond market is smarter than anyone at predicting what the Fed is going to do, is hyper efficient because it's such a big market. And essentially, they're going to drag it back down here to 2.7, hitting more towards that target we were talking about in the Fed funds rate. And guess what's going to likely happen after that? I don't want to speak in absolutes, but I think what you've got is the potential opportunity here for us to whipsaw, come down here and start to build back up and start expanding rapidly. And that's, again, if you look back at the chart here, we don't have all the history here, but the 30-year yield got up to 10% back in 87. And even higher, I think, prior to that, because of the Fed hiking interest rates. So the bond yield charters where it anticipates that the Fed is going to go with interest rates. That's what I think is like really the big news story. If that happens, I mean, you can just see here, this is a generational type event for financial markets, if we think about it. If we take it here, and this is the quarterly chart here. So each of these candles represents 3 months. I mean, this is already a significant breakout here. It signals that we're about to reverse on interest rates. And what the Fed is going to have to do eventually, they are eventually going to have to expand it quite high. I don't know if we'll get the same double digits that we got in the past, but it's going to be high, and it's going to be painful for the economy in the short while. So that's like kind of the 6-month, year-long lookout. In the short term, I think we get relief off of the Fed's obvious move towards short-term softening in the economy and pulling back its commitments to quantitative tightening.
Well, I think that's really interesting. And so just to kind of, set the background for anyone who's listening as we, move here, the Fed's kind of stuck between a rock and a hard place right now. We both have ridiculously high inflation. We also are in an impending recession. And of course, with the Fed, when you see recession, the Fed's number one move is to go ahead and lower interest rates. It makes it easier to borrow money, makes it easier for people to spend and continue to live their lives. And so for that reason, the Fed would want to be very dovish to cancel recession. We've seen the White House come out trying to, saying it's not over yet. We have a chance we could avoid recession. And I think Jerome Powell's even kind of tried to say, hey, we're still trying to avoid recession. So those are the momentum saying, hey, lower the interest rate. And then the other side is when you have high inflation, what you do, you raise interest rates. And so he's sitting in both of them. We have high inflation and recession coming. What do you do? So it sounds like, Nicholas, you're saying that you're expecting them to go after keeping us out of a recession rather than actually fixing the dollar.
Yeah, I think there's political pressure for it. Again, it's not even like an opinionated thing. The Biden administration, just like any other presidential administration, is knocking at the door of the Fed saying, essentially, we're already having high inflation here. Don't put us into a recession right now. That's the last thing I need. And it's a rock and hard place. Do you continue propagating inflation in the economy, or do you put us into a temporary recession? I mean, no answer is good, unfortunately. And this was not due to anything other than the monetary stimulus and the complete whack job we did to the supply chain system following the restrictions during COVID. Those two things have completely stunted the economy and put us in this position where supply chains are messed up. You have a huge, intense labor shortage in the market. This is something, if you look at the labor force participation rate and the number of job openings, they're completely inverse. There is less people participating in the economy before pre-COVID, and you've also got a record number of job openings, but you're not seeing salaries go up fast enough to cater into inflation, and you're also not getting those job vacancies filled. And this will eventually start to put us in, I think, likely into the inevitable seat where the Fed has to jack up interest rates, take upon the opportunity, put the economy in a recession. cool down inflation, let supply chains catch up, and boom, we'll be able to like return to normal to some degree. But the Federal Reserve, of course, will push it off into the last minute because they have a lot of global pressures. They've got governments, they've got
Yeah.
other central banks, they've got financial markets. They don't want to see it. We've got congressional members trading stocks, and I mean, there's a lot of people who don't want the Fed to have to do this hard decision, unfortunately.
Yeah. Well, let's go back to your Bitcoin chart real quick, and I'm going to ask you some questions
Yeah.
about what this then means
Okay.
potentially for some price movement here. Okay, so we're going to get a 75 basis point hike, rate hike this next week, right? So we
Mhm.
kind of feel like the price has been baked in on that. We're going to move a little sideways and go up, and then we have 2 months off, and then we come back with a 50 basis point, and then we have a 25 after that. So, do you believe that we could potentially move up and sideways throughout? That would put us through October. That we're still hovering up around $25,000 to $30,000 by October, or maybe even higher.
I'll be honest, I haven't thought about it that long out, but if we're taking a look at the weekly chart here, I think the one important thing for the bulls to understand is that it's going to take a couple of weeks to get up in this range. And I think if the
Yeah.
Fed moves forward with just doing a 75 basis point hike, I think you believe this as well, Tim, if I remember correctly from your content. Like, I think it's generally speaking that if the Fed does 75 basis points, it's already kind of, I think, starting to get priced in, but I think it's going to lead us
Yes.
up here into testing this consolidated range. And like you said, we can trade sideways for a while. We might even test below the range here as the 200 EMA is around here. I think it'll float around this range here going forward as price starts to come back up, and essentially
Hmm.
try to make this range support. And again, maybe even with lower like rate hikes and stuff, like as we progress further and further, that'll give us more confidence here that we can hold up in this range. But I think eventually we're gonna have this eventual turnover event where the Fed is gonna have to tighten again. That the CPI numbers are gonna surprise, and we're
Yeah.
gonna go, oh my gosh, it's getting bad again. And that will, even if the Fed doesn't react immediately, it's gonna spook asset markets like big time, because they're gonna
Yeah.
realize that just like back in the past, we've got that secondary wave here of inflation. So again, I say learn from the 80s, learn from history.
Hmm.
There's a lot to be learned there. And it's basically a battle isn't won overnight, essentially. We've got this
Right.
short-term relief rally, take advantage of it. But at the same time, like if you're just going all in trying to predict the bottom, it's going to be very difficult in this macro environment.
Yeah, but and that's it's so yeah, so hard to predict. I'm following because this is actually really cool. I think you are the first person I've ever heard think that not think that. I mean, I haven't heard a lot of people give their takes, but to give the take that they potentially will stay dovish going to 50 and then 25, which I think is a really interesting take. I actually think that you're just trying to follow the way the Fed's been acting and what they're trying to fight, choosing, hey, we're going to fight the recession word. We're not going to fight inflation. But tell me if I'm wrong. That actually, I think if that happens, I think we potentially could even break through 30 and head back up towards 40. Because as this happens, the value of the dollar is going to go down because inflation's still
Yeah.
going high. We're just not curbing the interest rate, not raising the interest rates. Bitcoin, commodities, gold, everything else is going up. But then, like you said, dragging it down the road is when they're going to kind of get more aggressive and say, all right, let's fix the US dollar. What do you think? And I know you said we can't make this prediction perfectly, but I think there's a wide held belief that October, November could be a good time for a Bitcoin bottom. But if what you're saying is true, I think that gets pushed off even further, maybe even all the way into mid 2023, which I don't think any of us really want. But if that happens the way you're saying, what do you think a more reasonable time frame for a bottom of the bear market would be?
Yeah, I mean, to be honest, it really depends in that Fed direction. But to the point you brought up, Tim, like again, I don't want to stand 100% in conviction of it, but I think when we
Right.
zoom out here to the long-term chart for Bitcoin, if we take it back again, I'm zoomed out here on like the monthly time frame. I think the thing that people forget sometimes is that bear markets are periods of stagnation where we really don't come back to the previous all-time highs and kick off a new cycle. It can last for a really long time. For example, back here in the past, we started off the bear market in the first, the significant one back here in June of 2011. We came down to lows
Hmm.
in November, but we pushed sideways really for a long period of time here going into 2012. And it was a long time before we came back to those previous all-time highs. And if you take a look here at 2013, we expanded further. And the big thing here that we need to understand, as a lot of people have rightfully pointed out, that again, it took me a while to really like pay attention to, is that Bitcoin has never really gone through one of the 40-50% plus bear markets. And I think that
Mm.
it's a very important thing to understand, like when we talk about equity market bear markets, like in the stock market essentially, The definition is typically 20% or more down. People have some variations of that, but generally we're already in a bear market in equities, clearly. The question remains, though, do we get the typical 20, 30% correction that has happened many
Yeah.
times over the last decade during this really like decade long bull run of credit expansion and equities and crypto and everything? Or are we going to get like a 2008 dot-com era like bubble pop where we go down essentially 40, 50, even potentially worse in equities? And if that
Yeah.
happens and crypto doesn't start to decouple and really start getting investors excited in it being an alternative hedge rather than a speculative asset, which is what people see it as now, that's going to crush crypto markets big time.
Yeah.
And all the fuel will be there for it to happen, because if everyone starts
Mm.
longing that 30K range, if we push sideways, we consolidate sideways for a while, people are thinking, oh my God, the merge is happening. We're ETH is scaling now. The new market cycle is about to start, and they're starting to put their leverage longs. They want to start revenge trading and getting back for the losses they made months ago. It is going to
Yeah.
give all of the perfect setup for things to go right back down, and it's going to be painful yet again for those people.
Mm.
Like, and that's the big thing on my channel. It's not that like you can't leverage trade or use leverage as a tool. I think if people educate you properly on how to use it, it can be fine. But leverage is something we don't talk about on the channel. We don't promote it, and the reason why
Hmm.
is because it can really like rob you of your entire exposure long term. And who knows, in a year or
Yeah.
two, even if you just dollar cost average now, you could be doing great, no matter how bad the macro environment is now. But I recommend people stay away from leverage. It's going to cause more pain than good.
No, do you want to hear something really sad, Nicholas, that my team and I were doing
Mhm.
some numbers on? So I'm not
Yeah,
even going to show it on the chart, but back on July 18th, right? Bitcoin was rallying, and it pulled back down 4%. Okay, 4%.
right.
I think maybe five, if you did Wix 5%. If you bought right at the peak on July 18th, the rest of the day it came back down. Let's say 5%. There were millions of long liquidations on that day, and I'm
Yeah,
sitting here saying, how in the world did people? It's leverage. These people were putting up 25 or greater X leverage and getting lit. And it's just like, oh my goodness. Like, I mean, I'm really big. I'm really, really big. I tell people all the time, like, hey, you got to play very, very careful with leverage. And I'm of the personal opinion. Everyone else, you got to decide your own risk to reward ratio. But I'm interested to hear what your number is. For me, it's 5x. If I ever entered a trade with 5x, I feel I'm really bold that day. I just have a lot of confidence. There's just so many things pointing. But even to me, like I would enter a 5x and be like, oh, okay, this is really shaky ground right here. To me, even 2x, you're starting to be like, okay, this is playing with fire here.
exactly.
What is your thought? What's your number?
I think in crypto it doesn't make sense to use any more than two or three if you're going to use it.
Yeah,
Like, I mean, like again, like five if you're doing like a short term trade. I think that that's
right.
fine. You have proper risk management. The only thing I would say though is that people I really don't think understand like about leverage trading, that I always try to get across, because it makes it really like you really realize how personal it is. These platforms that promote leverage as their core product line through perpetuals or whatever, they're casinos in my eyes. They know that 95% of the customers who come through are going to lose money. And again, you can take a look at a more mild version of this. If you go to like traditional trading platforms in Europe, they make them promote the number of how many traders either lose money or lose like their entire funds. And you'll see numbers like 60, 70%. When you add leverage into the equation, those exchanges essentially know when you make a deposit, they're like, oh, cool, that's revenue for us. We just made money. Like, because they know that on paper, and that's why they give on like the big sign-on bonuses and stuff. It's because they know you're going to lose money. And what I would hate to see right now is in a time where inflation is so bad, where it's crippling people financially, to lose what little remaining disposable income you have into investing or trading on leverage, and you just give it to an exchange or a smarter trader in the market who's going to hunt your stops, hunt your liquidations, and get you forced out of your position whether you like it or not, because you got a bit greedy or took on too much leverage. I would hate to see people fall into that trap. So yeah, I mean, again, I'm sorry if I get like a bit opinionated and like emotional about it, but it's like I know some people who have lost generational wealth off of leverage trading, and I see it like
And
going to a casino and betting it all in a game of poker, essentially.
Yeah, it's funny because we all know somebody. I think anyone watching here has heard of somebody getting massively hit hard with liquidations. What's even worse, I know someone. I know someone who is the taker, and I was actually having a conversation with him. For those who don't even know who he is, his name's Magic Internet Money, and I would love to get him,
Mm.
maybe even on this show at some point to talk, because he uses this tool where he's looking at volume down to like within like the seconds. And he was walking me through it. And he was literally like, "Yeah, so if you see right here, you can watch the longs being entered, but you can see when it starts to trickle out, and I can pinpoint the moment that those longs are vulnerable, and I can short them, and he said, unfortunately, he's like, you kind of sometimes, to make money doing it this way, you got to realize, I'm making money because I'm taking this from somebody else.
Yeah.
And so the thing is, like, there are people out there that are so good at trading, and their tools are so detailed. They literally know how to take your money when you're entering these leverage longs and shorts. So it's definitely something you got to be so careful with.
Yeah.
We have a couple minutes left here. Oh yeah, did you have a response to that? Sorry, didn't want to cut
No,
you off.
no, no. I think you hit on it perfect, Tim. I would say, like, again, if there's people out there who are going to do it either way and they're like, I don't care, I want to go leverage trade, keep your
Yeah.
margin, like, keep your leverage levels like low single digits. I think, again, as you mentioned, max five, really like 2 to 3x, I think is more sensible, like for like larger positions of your capital. I think the
Mhm.
secondary thing as well is to always have additional margin on standby. Um, Make sure that you can deposit funds into your account and protect yourself, and make sure
Mm.
that you lower your liquidation price. Never go all in. That is the biggest mistake. And ironically enough, that's what leverage as a tool is helpful for, is that it helps you to have a smaller position size and you can still have the same kind of market exposure. So anyways, yeah. No, anyway, we can continue
Yeah.
on something else, but I just wanted to
No,
share that
and
as well.
we're gonna have to wrap it out here soon. It's been a great, like I told you,
Mhm.
we could be here for 3 hours. Unfortunately, we had
We
45
could,
minutes.
man.
But I wanted to give your last question. I wanted to get your quick take on what your thoughts were of Elon and the Tesla news that came out here the other day, with them selling about 75% of their Bitcoin. Do you think that it actually could have been potentially a bullish move for the price of Bitcoin, or do you think that they were going to see some bearish ripples that come from it?
Yeah, I think on, like, I've got it like the Tesla chart up here to kind of talk a bit about that, like in the sense of what it means for crypto. I think it's phenomenal news to see how Bitcoin performed with that kind of sell side
Yes.
pressure plus all the liquidation. I think it's an incredibly bullish sign for price to have that kind of visit to 30K. I think the reason
Mm.
Tesla did this is because if you really look at it on like the long term chart, so we're looking all the way back since 2017. I mean, throughout this entire period of time, this is when Tesla proved the world wrong. They got to profit. They kept launching new product lines like the Cybertruck, things that, like, again, just kept making people more optimistic about Tesla. And right up here, interestingly enough, in January 2021, this is where crypto really started to take off. And throughout this period of time, Elon really started to divest and focus on other things, Dogecoin, Tesla buying Bitcoin, all this stuff. And it's
Hmm.
incredible to see like the change in momentum here. I mean, eventually things have got to cool down for sure, but you can see that we've been generally neutral here for more than a year now. So I think that
Right.
Tesla is selling Bitcoin. It's de-exposing itself because it wants to prove that it's going back to its business model of innovation and technology, that it's not going to focus so much on, and I don't mean to say crypto is frivolous or anything. I love crypto, but for Tesla, it's not a part of its business model. So I
Yes.
think
Right.
that's where they're going with it and stuff. And they even ate a pretty big loss on it, $200 million. So probably not an easy decision.
Hmm. Well,
But
last question we have here, and this is going to be a chat question, and then we'll wrap this one out. Nathan Alvarado asked, "What does Nick think of the BITO ETF that shorts Bitcoin?"
that's a great point. So yeah, I think that ironically enough, that came out at a time when it's probably one of the worst areas to short Bitcoin, just like how some of the Bitcoin ETF came out earlier, I think last year. I honestly think that with the important thing to understand about these is that these are based off futures contracts. They're like
Hmm.
ETF derivatives products. ETFs built on top of derivatives, essentially. I would not hold these because over time, my understanding is that they're going to have time decay, which is what happens on any kind of derivatives-based ETF as they have to rotate the contracts. It sounds a bit technical, but essentially speaking, even if you were right on the trade and it goes up, you're going to make less than you would have just shorting on a derivatives platform, or trading like Bitcoin futures. So I would say that it's a tool if you want to do like a very short term trade, maybe for a day or two. But like long term, it's very risky because you could be wrong on the trade going short. And outside of that as well, you're going to have that time decay, even if you're on the right side of the trade. So like holding it for a year is going to eat up a lot of your gains, even if you made the right trade.
Mm. Well, Nicholas, this interview, I've just been so honored to get to talk with you. Thank you so much for taking time out of your day to come here on Cointelegraph and get this interview. If any of you guys are watching this and you're like, man, I love Nicholas, how can I go hear more from him? He's got a YouTube channel, like we talked about in the intro. He's one of the big boys in crypto YouTube. So go follow him on YouTube. Also on Twitter, he's got Nicholas_Mertens right there on Twitter. Go follow him there. Closing thoughts from you, Nicholas, before we let you go.
Oh, Tim, it's been an honor, man, to be here. I want to thank you guys for having me. It was great getting to chat with you, man. I think it's been a long time coming. I think the big thing I would say overall, like just for too long, didn't read. If you want to pass it on to a friend, I think we've got the summer relief rally. Good chance we're going up to 27.5 to 30K. Bet on the Federal Reserve pivoting at one point, making things easy, justifying the relief rally in equities and crypto. And I think sometime in the late fall, winter, going into 2023, we're going to have to roll back over into the same pain. The Fed's going to lose control again. Commodity prices will go up, and we've got an extended bear market. I think that's what we've got. Again, could be wrong, but that's where I'm placing my cards at the moment, or at least what I'm seeing for the time being.
Gotcha. Well, Nicholas, thank you so much. Everybody else, thank you for watching this show today. Make sure you smash that like button before you go if you loved this content. Also, subscribe to the channel, Cointelegraph, so you can get more videos just like this. With that being said, though, we'll see you guys next week. Peace.